Good afternoon to all of you. This is Ma'am Pat Empleo, your facilitator for this topic, leases. And we are now in video 2 or part 2 of IFRS 16 leases. So let me share my screen. So in part 1, we have identified the essential elements of a lease contract, and we focus on accounting for leases in the books of the lessee. So in part 2, we will now focus on accounting for leases in the books of the lessor. So at the end of this module or after viewing this video, you should be able to account for leases in the books of the lessor, whether that lease is classified as operating lease, direct finance lease, or dealers or manufacturer's lease. You should be able to present lease-related accounts in the financial statements of the lessor, and you should be able to identify required disclosures relating to leases. So from the point of view of the lessor, a lease is either operating lease or finance lease. So an operating lease is one of a simple rental arrangement, and it is accounted for that way, meaning in the books of the lessor, any collection of rental is considered to be or is to be recorded as rent income or unearned rent with appropriate adjusting entry at year end. So it's just a simple rental transaction. Whereas finance lease is one that is accounted for by the lessor as, in effect, sale of asset to the other party, and that other party is the lessee, such that the periodic payment that is received by the lessor from the lessee is considered to be installment payment or installment collection of the asset that is sold to the lessee. So how do we determine whether the lease contract is to be accounted for as operating lease or as finance lease? Please take note that accounting for leases as operating lease or finance lease is not an option of the lessor. So there are leases that are to be accounted for as operating leases, and there are leases that are to be accounted for as finance leases. So a lease is finance lease if it transfers substantially all the risks and rewards incidental to the ownership of the asset to the lessee. So that is the overall guiding principle. If the contract of lease transfers substantially the risks and rewards incidental to the ownership of the asset to the lessee, then that lease will have to be accounted for as finance lease. The risk here, relate to the risk that the asset may be impaired while being used by the lessee. Risk also includes the cost of ownership that may be shifted to the lessee, which may include costs for repairs and maintenance, taxes, and insurance. Whereas rewards that are transferred to the lessee may be in the form of cost reduction or revenues that may be generated by the lessee from the use of the asset being leased. Therefore, the economic benefits from the asset had been transferred from the lessor to the lessee. So how do we determine whether there is a substantial transfer of risks and rewards incidental to the ownership of the asset to the lessee? So IFRS 16, similar to IAS 17, enumerates indicators of finance lease. So only one indicator is necessary for the lease to be accounted for as finance lease. So first indicator is transfer of title. So if there is any provision in the lease contract that at the end of the lease term, the title to the property or to the asset will be transferred to the lessee, then in effect, the transaction is really one of a sale, and that the lease contract is just a protection to the seller that the full selling price of that asset will be collected from the lessee. Second is bargain purchase option. So as previously discussed in part 1, a bargain purchase option is a privilege that is granted by the lessor to the lessee such that the lessee will be able to buy the property at a price that is significantly lower than the fair value of the property at the date the option becomes exercisable. And the date the option becomes exercisable is the end of the lease term. Meaning, simply stating, if at the end of the lease term, the lessee can buy the property at a price, at a bargain price, meaning at a price significantly lower than the fair value of the property at that date, then there is a bargain purchase option. That means, therefore, that as early as commencement, it is already reasonably certain that the lessee will exercise the purchase option. Third, the lease term is for the major part of the economic life of the asset. The economic life of an asset may be expressed in terms of period, let us say years, or in terms of productive hours or unit of output. So major part here means more than 50%. So if the lease term is for more than 50% of the total useful life of the asset, then it is to be accounted for as finance lease. Or if the first 3 are missing but you have number 4 at the inception, the present value of the lease payments is substantially all of the fair value of the lease asset, then that is to be accounted for also as finance lease. So lease payments here include the total periodic payments. So this is your total rentals, including any of the following: the bargain purchase option in the second bullet, the guaranteed residual value and unguaranteed residual value. So from the point of view of the lessor, it does not matter that the residual value is guaranteed or unguaranteed. In determining the present value of the lease payment, both the guaranteed and unguaranteed residual value are taken into consideration, which we will exemplify later. Or if you are challenged as to the presence of the first 4, you may apply the 5th one. The lease asset is so special in nature that only the lessee could use it without major modification, meaning that the leased asset is tailor-fit to the need of the lessee, such that the lessor purchased or acquired the asset, so it was bought by the lessor or it was manufactured by the lessor, thinking specifically the special needs of the lessee, such that only that lessee could use it without major modification, meaning that the lessor simply finances the requirement of the lessee for that specific asset. Okay, so to determine again whether it's finance lease, these indicators, one of these indicators must be present. If no such indicator is present, then the lease will have to be accounted for as operating lease. So we now proceed to accounting for operating lease because that is the simplest in methods of accounting for leases. But may I emphasize that the method of accounting is not actually an option, but the method is dictated by the circumstances in the lease contract. Okay, so if no indicators for finance lease are stated or included in the contract, then you are to account for the lease as operating lease. So the principles for operating lease under the old IAS 17 and the new IFRS 16 are still applicable. So there is no difference between IAS 17 and IFRS 16 from the point of view of the lessor. Therefore, we take a look at the same principle. First, you are to recognize on a straight line basis lease income over the lease term unless another systematic basis can be justified. So you have to determine the total periodic payments that will be collected by the lessor over the lease term. So even if the periodic rental is not uniform, let us say the lease term is for 3 years. For the first year, you have 1 million annual rental, but it will be increased to 1,200,000 during year 2 and 1,500,000 during year 3. Therefore, 1,200,000 plus 1,500,000 plus 1,200,000 in year 2. Total will be divided over 3 to compute for the annual rental income, even if collection is not uniform, unless another systematic basis can be justified. So if this systematic basis is used by the lessor to recognize the rental income, then you have to explain in the notes to the financial statement such justification. So we have here initial direct costs. So initial direct costs may be incurred by the lessor or they may be incurred by the lessee. So if this is incurred by the lessor, then such initial direct costs are capitalized as part of the carrying value of the lease asset. And then such initial direct costs, because they are capitalized, will have to be subjected to depreciation. Therefore, there are two costs to be depreciated: the initial measurement basis of the lease asset plus the initial direct cost. Of course, the initial measurement basis or the carrying value of the leased asset will have to be depreciated over the useful life of the asset, whereas the initial direct cost is to be depreciated only over the lease term. Third, contingent rents are taken to profit or loss in the period in which they arise. So contingent rents are those variable rental collection that are not fixed, but they are based on some variable such as revenue that is earned by the lessee because of the use of the lease asset or usage by the lessee of the asset. So let us say again, if there is a provision in the lease contract that additional rental of, let us say, 500,000 will accrue to the lessor if revenue of the lessee exceeds, let us say, 100 million for a period. So if the rental revenue exceeds 100 million, then you have to pay for that additional rental. So that additional rental is taken to profit or loss in the period in which they arise. Executory costs. What are these again? Executory costs include repairs and maintenance, property taxes, and insurance. So they are charged to profit or loss based on appropriate recognition principle. And because the asset is still controlled by the lessor, because there is no substantial transfer of risks and rewards to the lessee, then the lessor still retains the record for the asset. And if that is so, it follows that depreciation will have to be taken up by the lessor, and depreciation will be recorded based on the normal depreciation policy. So you have to consider the depreciation method adopted by the company, as well as whether the company considers the residual value for the asset. So depreciation has to be provided, computed, and recorded based on the lessor's depreciation policy. Therefore, in summary, what are the characteristics of operating leases? That is, the lessor still maintains the record for the lease asset. So because the record for the asset is maintained by the lessor, then the lessor also recognizes depreciation on the lease asset. The depreciation, if there is any initial direct costs, consists of two components: depreciation on the carrying value of the asset before initial direct costs, which will be computed based on the useful life of the asset, and depreciation based on initial direct costs, which will be computed based only on the lease term. Then, additional expenses such as repairs and maintenance, taxes and insurance are also included in the financial statements of the lessor. Additional rent income may be recorded by the lessor based on contingent rental. Okay, so let us have an example. Provident Company purchased an equipment on July 1, 2020 for $1,500,000 cash for the purpose of leasing it. The equipment has an estimated useful life of 10 years from the date of purchase. Let me just check whether I have recorded. Yes, so let me go back to my screen, therefore. On October 1, 2020, beneficial lease from Provident Company this equipment for a period of 3 years at a monthly rental of $30,000 payable in advance at the beginning of each month. Beneficial also paid $54,000 lease bonus to Provident. So that means that Provident received additional $54,000 from Beneficial. That is at inception on October 1, 2020. During the year 2020, Provident Company paid $15,000 for repairs of the equipment. Okay, so this is to be accounted for as operating leases. There is no expressed provision as to transfer of title. There is no bargain purchase option. The lease term here is 10 years. Useful life is 10 years. The lease term is 3 years, so that is not major. So even without discounting, 1,134 is less than 50% of 1,500,000. I said even without discounting, but that 90% rule will apply to the present value, not necessarily the gross amount. And therefore, clearly, there is no indicator for finance lease. So this will have to be accounted for as operating lease. So your first principle is that total rental that will be collected over the lease term will be spread uniformly on a straight line basis over the period of lease uniformly. Therefore, let us compute for total rental income over 3 years. That is $30,000 for each month. So that's 12 months times 3 years. That's 36 plus the lease bonus that is provided by the lessee to the lessor, $54,000. Therefore, the total collection by the lessor over the lease term is $1,134,000. So if we are to compute the rental per month, rental income per month, that is $1,134,000 divided by 36. So it will give us 31,500. So what periods, therefore, are covered by this lease contract? So it will start October 1, 2020 and will end September 30, 2023. Therefore, your rental income for 2020 will be the uniform rent income of 31,500 times number of months from October 1 to December 31. That's 3 months. So that is 94,500. For 2021 and 2022, we have full year coverage in the lease contract. Therefore, that's 31,500 times 12, 378,000 for both year 1 and year 2021 and year 2022. Then, the remaining last 9 months of the lease contract would be for the year 2023, that is up to September 30, 2023. Therefore, 31,500 times 9 is 283,500. So, 1,134,000 total collection will be recorded as rent income, 94,500 in 2020, 378,000 in 2021, 378,000 in 2022, and 283,500 in 2023. However, collection may not be the same amount as rental income. So collection in 2020 will be 30,000 from October 1 to December 31 plus the lease bonus that has been provided by the lessee at inception, 54,000, minus the rental income of 94,500. Therefore, accumulated collections exceed the total rent income for the year by 49,500. So 49,500 is to be presented in the statement of financial position as unearned rent. If, on the other hand, the collection is less than the amount of rent income that is to be recognized, then the excess of that income over collection will be reported by the lessor as asset. That will be reported as lease receivable or accrued rent income. For the year 2021, we start the year with an earned rent of 49,500. This is the first rent that will be earned during this period, plus the collection of 360,000 minus the rent income that will be reported in the statement of comprehensive income of 378. So still accumulated collection exceeds the rent income recognized for the year. So we have an earned rent of 31,500 at December 31, 2021. For the year 2022, we start the year with 31,500 unearned rent here, plus collection for 12 months of 360,000 minus the rent income that is recognized in the statement of comprehensive income, 378,000. So we have an earned rent at year end of 13,500. Then for the last year of the lease coverage, we have 13,500 beginning balance of unearned rent plus collection for the last 9 months of 270,000 minus the rental income that is to be recorded from this lease contract, 283,500. So this will result to zero already. That means no item relating to the lease collection will be reported anymore in the statement of financial position. In addition to this unearned rent presented in the statement of financial position, of course, because the lessor still maintains the asset for 1,500,000, this asset will have to be reduced by the recorded accumulated appreciation. For the year 2020, because the asset is already available for use as early as July 1, 2020, so if depreciation is provided using a time factor method, then depreciation will have to be computed starting July 1, 2020. So you have to compute depreciation here, plus you have to present as part of the expense of the lessor 15,000 repairs and maintenance for the asset. Okay, again, in operating lease, the lessor presents in its financial statement the asset that is being leased out reduced by any accumulated depreciation. Then, in addition, any excess of collection over the rent income is presented as a liability in the form of unearned rent. If we have a reverse situation, if collection is less than the amount of rent income that is recognized, then we shall have rent receivable. In the statement of comprehensive income, we are presenting rent income as computed here. Then in addition, we shall present depreciation expense on the lease asset and the executory cost, in this case, repairs. Okay, so we are now shifting to finance lease. Again, finance lease is in effect sale of asset by the lessor to the lessee. So, finance lease is accounted for either as direct finance lease or dealer's lease. Again, these are not alternative accounting methods. There are some leases which must be accounted for as direct finance lease and some leases that must be accounted for as dealer's lease or manufacturer's lease. So, whether this finance lease is direct financing lease or dealer's lease, at commencement, the lessor shall recognize the assets held under finance lease as receivable at amount equal to the net investment in lease. So, the net investment in lease actually is the present value. So, if this is gross, this may also be net, depending on the method that you are to use. Therefore, this receivable is a financial asset that is covered by IFRS 9. Generally, it's financial asset at amortized cost. Okay, because the asset subject to the lease, so the underlying asset's record is to be transferred already to the lessee, then the lessor shall not present that underlying asset in its financial statements. The lessor shall present the receivable from the lessee. That receivable is technically termed net investment in lease or simply finance lease receivable. They mean the same. So in discounting, in determining the present value, the discount rate to be used is the implicit rate of the lessor. So there is no alternative rate here because, of course, the lessor knows its own effective rate of return, and its desired rate of return is actually its implicit rate. Okay, so again, finance lease is either direct finance lease or dealer's lease. So, how do we determine whether it's direct finance lease? The lessor is a financing company. Therefore, if this is a financing company, generally, the only revenue that is derived by this lessor is finance revenue, which is the interest revenue. And the interest revenue is earned over the lease term using the effective interest method. So if we are a financing company, therefore, we are after our receivable from the lessee. So we are to recognize a financial asset, which is finance lease receivable, otherwise known as net investment in lease. This will have to be measured at present value of the minimum lease payments and based on the definition of IAS 17 or IFRS 16 for minimum lease payments. They include periodic payments on rental, bargain purchase option, or guaranteed residual value. However, even if the unguaranteed residual value is not part of minimum lease payments, such receivable also includes the unguaranteed residual value. Therefore, to the lessor, if there is a provision that at the end of the lease term, the underlying asset is to be returned to the lessor, the residual value, whether guaranteed or unguaranteed, is always included as part of finance lease receivable. Then the initial direct costs increase the amortized cost of the finance lease receivable, meaning the present value, without increasing the gross receivable because this is directly paid by the lessor. That payment actually will not increase the gross receivable that will be collected from the lessee, but it will reduce only the interest earned over the lease term. In effect, if here you have computed already an interest rate, but subsequently you incur initial direct costs, the amount of interest rate that you computed here will have to be adjusted because it will, incurring initial direct costs will reduce the interest earned over the lease term. So it will also decrease the effective rate. So if there is no statement as to whether from the lease contract the lessor is a seller or a dealer, a manufacturer, or a financing company, how do we determine? So we have to be guided by this relationship. If the present value of the lease payment receivable, which is actually the net investment in lease, equals the fair value of the asset, which in effect is the selling price, and the selling price is equal to the carrying value of the asset. So if selling price equals the carrying value of the asset, then there is no profit on the transaction. Therefore, the lease contract is not a sale. So if it is not a sale, it will not qualify as a dealer's lease. The lessor is not a dealer. So if it is no sale, if it is not a sale, it also will not qualify as a manufacturer's lease because there is no sale of asset. Again, if present value of lease payment receivable equals the fair value of the asset and equals the carrying value of the asset, hence there is no profit derived at commencement, and because of this no profit, this is not a sale. So this is not dealer's lease, this is not manufacturer's lease, this is direct finance lease. So we go to an example of direct finance lease. Or before the example, let us have the pro forma entries. So this is using the gross method of recording the finance lease receivable. So we debit finance lease receivable. This is the total of the periodic payments over the lease term plus any of bargain purchase option, guaranteed residual value, or unguaranteed residual value. Credit the asset, of course, at carrying value, but the present value of the finance lease receivable equals the carrying value of the asset. So the difference between these two, this is at gross, this is at present value. So the difference between the gross and the present value is the amount of finance revenue that is earned over the lease term, which shall be recognized initially as discount on finance lease receivable. So in the financial statements of the lessor, the ledger balance of discount on finance lease receivable will have to be considered as a valuation account for finance lease receivable, meaning this one, the discount is to be deducted from finance lease receivable to arrive at the present value or amortized cost. That amortized cost is called net investment in lease. In most cases, the payment of the rental is made in advance. So for the collection at commencement, the entry is to debit cash credit finance lease receivable. Please take note that there is no interest that is recorded here because this is made at commencement. This is also made at commencement, so there is no time lapse. Hence, no interest income. However, in the subsequent collection, because there is time lapse already from the date of initial collection to the date of the subsequent collection, then there is an amount that will be reported as interest income. So your entry is to debit cash, credit finance lease receivable at gross. However, the amount of interest income that will be amortized is recorded by debiting discount on finance lease receivable and crediting interest revenue. So we are to prepare an amortization table similar to the amortization table that we prepared in part 1 for the lessee. Now, if the anniversary of the lease does not coincide with the end of the reporting period And because interest accrues with the passage of time, then we have to update the accrual of interest, which is recorded in this manner: debit discount on finance lease receivable and credit interest revenue. Okay, so we go now to illustrative problem 2. On April 1, 2020, Benton Company lease equipment to Ironman Corporation. The term of non-cancelable lease is 8 years with no renewal option. The annual payment is $80,000. First payment is due April 1, 2020. So, $80,000 is collectible in advance. The estimated useful life of the equipment is 10 years. So 8 over 10 is majority. So the third indicator is met. The cash price of the equipment is $539,730 at April 1, 2020, which is the same as the carrying value of the asset in the books of Benton. Therefore, cash price is the best indicator of the fair value of the asset. So the fair value is $539,730. Its carrying value is also $539,730. So there is no profit from sale. Hence, this is to be accounted for as direct finance lease. The residual value at the end of the lease term, which is guaranteed by Ironman, is $80,000. Again, if ever the residual value falls below $80,000, then the lessee will be required or is obliged to pay any deficiency to the lessor. Therefore, $80,000 is part of finance lease receivable. This is to be collected from the lessee either in the form of the asset that will be returned to the lessor or in the form of cash in case the residual value falls below the residual value falls below the amount that is guaranteed by Ironman. Benton uses the calendar year as its reporting period, therefore its year end is December 31. The implicit rate used by Benton to compute the periodic payment is 8%. And therefore, if you are to discount the total of 80,000, there will be 80,000 as periodic rental plus the 80,000 in the form of guaranteed residual value using present value factor of annuity due. Annuity due because payment is made in advance. For 9 periods, you will be arriving at present value of 539,730. Therefore, we prepare this amortization table. So on April 1, 2020, before the first collection, the amortized cost or the present value of the total payments accruing to the lessor is 539,730. And on the same date, April 1, 2020, we made a periodic collection of 80,000. Because there is no time lapse again, that 80,000 is supplied immediately in full to the principal. So the principal is reduced by 80,000. So it is reduced to 459,730, which now becomes the basis to compute for the interest that will be applied in the subsequent periodic collection. So in the periodic collection, the amount applied to interest is 36,778 deducted from 80,000. Therefore, the difference is the amount applied to principal. However, this lessor reports on a calendar year basis, so although collection is made every April 1, adjustments will have to be made as of December 31 to update the accrual of interest. Therefore, what will be our entries? At commencement, we have to recognize our finance lease receivable. So on April 1, 2020, we debit finance lease receivable, 720,000, that is 80,000 times 8 plus the guaranteed residual value of 80,000. Credit equipment for lease at carrying amount of 539,730, which equals the present value of the total payments accruing to the lessor, including the present value of the guaranteed residual value. Again, this is the gross, this is the net, such that 180,270 is the account that reduces the gross to net. So this is the total interest that will be earned by the lessor over the lease term, 180,270. So that is credited to discount on finance lease receivable. On the same day, we collected the first 80,000, so we debit cash 80,000 and credit finance lease receivable 80,000. At December 31, based on our amortization table, so the interest here is 36,778, but that interest runs from April 1, 2020 to April 1, 2021 for 12 months. But we are reporting on a calendar year basis, so the first 9 months of this interest is part of the year 2020. So 9 over 12 of 36,778 will be recorded as interest income at year end. So 36,778 times 9 over 12 is 27,584. So we debit discount on finance lease receivable 27,584, credit interest revenue 27,584. Please take note that the lessor does not recognize any depreciation because the asset has already been transferred for accounting purposes to the lessee, such that there is no equipment for lease already in the ledger of the lessor. Hence, no depreciation is to be taken up. So, in the year 2021, to record the second collection, we debit cash 80,000, credit finance lease receivable 80,000. And then, the remaining 3 months of the first interest in our amortization table will have to be transferred to interest revenue. So this is the interest from January 1 to April 1 of 2021, which is actually 36,778 minus 27,584. So the remainder of 9,194 is recorded as interest income for the first 3 months of 2021. Then at year end, any subsequent interest in our amortization table, again this one, is actually earned from April 1, 2021 to December 31, 2021. So we have to take up the first 9 months. So that is 27,584. So we debit discount on finance lease receivable 27,584 and credit interest revenue for 27,584. Or, may I correct myself? It's 24,991, which is 32,893 times 9 over 12. So that previous amount is actually your adjusting entry at the end of 2020. Okay, so how do we present the effects of these journal entries in our financial statements? So let us present the financial statements for the year 2021. So in the statement of financial position, what will be our balances for finance lease receivable? So let us compute the balance of finance lease receivable. So we have an initial balance of 720 minus 80,000 minus 80,000. So 720 minus 160 in effect is 560,000 total. Then determine the balance of discount on finance lease receivable. So your discount on finance lease receivable was initially established at 180,270, reduced by 27,584 at the end of 2020. On April 1, further reduced by 9,194. And on December 31, 2021, reduced further by 24,991. Therefore, remaining balance of discount on finance lease receivable is 118,501. So the amortized cost of finance lease receivable, which you may call as net investment in lease, is 441,499. If the company uses the current, non-current presentation of assets and liabilities, the finance lease receivable will have to be split into current portion and non-current portion. So the amount of principal that is due next year is the year 2022, will be included as part of current portion. So how do we check this 441,499? So as of April 1, 2021 is in our amortization table. As of April 1, 2021, your amortized cost is 416,508. However, interest is to be taken up from April 1, 2021 to December 31, 2021 based on our last adjusting entry, which is 24,991. So we have additional accrued interest of 24,991. So the amortized cost is 441,499. So 560,000 minus 441,499. This must be the ledger balance of discount on finance lease receivable as of December 31, 2021, which will have to be split into current portion and non-current portion. So the current portion is the amount of principal due in 2022. This is based on your amortization table, plus the interest that is accrued as of December 31, 2021, which is 24,991. Therefore, the total current portion is 71,670. So you transfer here the amortized cost of 71,670. But come April 1, 2022, you are collecting 80,000. So the appropriate discount there is 8,330. Therefore, this is a squeezed figure. That is 560 minus 80, that's 480,000. 118,501 minus 8,330. The non-current portion of discount on finance lease receivable is 110,171. Therefore, the non-current portion of finance lease receivable is 369,829, which you may correct, you may check, validate from your amortization table. This is it. So as of the end of 2021, we have amortized cost of 416,508 plus the interest accrued as of December 31. This portion of the principal is classified as current, plus it has to be adjusted by the amount of accrued interest for 9 months. And 416,508 minus this portion of current, this amount of 369,829 will be presented as non-current portion of finance lease receivable, which is presented in our case 369,829. Okay, so in the statement of comprehensive income, you are just to present interest revenue of 34,185. This is the only revenue we are presenting, unless of course there is contingent rental, which is reported as lease revenue, but there is none. So your interest revenue here is the total in our entries for 2021 of 9,194 and 24,991. So that is based on effective interest method. Okay, so that's one problem, illustrating direct finance lease. And in our illustration, there is guaranteed residual value. So, will it matter if the residual value is unguaranteed? No, it will not matter. So, even if the residual value is unguaranteed, we shall also have the same set of solution, because to the lessor, for accounting purposes, it does not matter that the residual value is guaranteed or unguaranteed if the lease is direct finance lease. Also, if that 80,000 is considered as a bargain purchase option, the bargain purchase option is also included as finance lease receivable at gross, and its present value will likewise be included as part of the net investment or the present value of the lease payment receivable, otherwise known as net investment in lease. Therefore, in our illustration just concluded, that 80,000, whether it is guaranteed residual value or unguaranteed residual value or bargain purchase option, this will have to be included in the lease, finance lease receivable at gross, and its present value will be included in the amortized cost of finance lease receivable. We now proceed to dealers or manufacturers lease. At commencement, there is a revenue that is reported, and that is sales revenue. Why? Because the lessor here is a dealer or a manufacturer. Therefore, this dealer or manufacturer uses lease as a means of selling its inventory. Sorry for that. Okay, so how do we determine whether it is to be accounted for as dealers or manufacturers lease if nothing is mentioned about the nature of business of the lessor? So the present value is equal to, that is the present value of the finance lease receivable is equal to the fair value. This fair value is the selling price in effect, and this selling price exceeds the carrying value of the asset. Therefore, this excess of selling price over the carrying value of the asset is actually the profit, which is earned by the lessor at commencement. And this profit makes this a sale transaction, hence dealer's lease or manufacturer's lease. Therefore, at commencement, our entry is to debit net investment in lease, credit sales, if the company uses the net method. If the company uses the gross method in accounting for the financial asset, then debit finance lease receivable at gross, credit sales at net. The difference is your discount on finance lease receivable. Because this item is one that is carried in inventory, because this one is a dealer or a manufacturer, and it is expected that the company uses the perpetual inventory system, because what is being leased out under dealers or manufacturers lease is inventory of significant amounts. Therefore, it is expected that the company uses the perpetual inventory system. So, we debit cost of goods sold and credit inventory. Now, all other entries for the collection of the finance lease receivable and the year-end adjustments for the accrual of interest will be the same as in direct finance lease. We go back now here. On April 1, 2020, Benton Company leased equipment to Ironman Corporation. The term of the non-cancelable lease is 8 years with no renewal option. The annual payment is 80,000. First payment is due April 1, 2020. Estimated useful life of the equipment is 10 years. The cash price of the equipment is $5,397.30. at April 1, 2020, while its carrying value in the stock cards of Ben 10 is 399,730. The residual value at the end of the lease term, which is guaranteed by Ironman, is 80,000. Ben 10 uses the calendar year as its reporting period. The implicit rate used by Ben 10 to compute the periodic payment is 8%. Therefore, your net investment in lease, or the present value, which is the sales price, is 539,730. So we have the same amortization table. What is different in this problem is that the carrying amount is lower than the fair value. So the difference between this fair value, which is the selling price, and the carrying value, which is maintained in the stock card, meaning it's an inventory, is actually the gross profit that is earned by Ben 10 at commencement. So that we have the following entries. On April 1, 2020, we debit finance lease receivable, including the guaranteed receivable value, 720,000, credit sales at the equivalent cash price, which is 539,730, which is the present value of all the payments, including the guaranteed residual value. The difference between the gross and the net is actually the interest that will be earned over the lease term, which is credited to discount on finance lease receivable. Then you record your cost of sales. Debit cost of sales, 399,730, and credit inventories, 399,730. So in your statement of comprehensive income, 539,730 minus 399,730, which in effect is 140,000, will be presented as gross profit. That is a gross profit that is earned in 2020 during the year of commencement. Now, in addition to the gross profit during period of commencement, there will be additional revenue that is earned over the lease term, and that is your interest revenue. So debit discount on finance lease receivable and credit interest revenue, so same computation as before. Then subsequent collections for year 2021 will be recorded in the same manner as we recorded them under direct finance lease. Okay, so in illustrative problem 4, there is a highlight here that the residual value is not guaranteed by Ironman. So in the previous example, the residual value here is guaranteed by Ironman. Therefore, that residual value is included in the computation of sales. In illustrative problem 4, the residual value is not guaranteed by Ironman. So, in effect, this 80,000 is unguaranteed residual value. However, Ironman will still be required to return the asset at the end of the lease term. So it is expected that something will be collected from Ironman, and that something is actually the asset, which is estimated by Ben 10. So in the computation of the finance lease receivable, that residual value, whether guaranteed or unguaranteed, will not matter. Hence, we have the same amortization table. However, in our entries to record sales and cost of sales, it will matter already, because any residual value that is not guaranteed will be considered as an adjustment to cost of sales at present value. In our example, previously, the 80,000 guaranteed residual value at present value is included here in the credit to sales. So the present value of the guaranteed residual value is included in the computation of sales. Whereas if the residual value is unguaranteed, the sales that will be recorded here will only be the present value of the rental payments excluding the residual value. So your sales here is adjusted to only 496,506, and the present value of the unguaranteed residual value is to be deducted from the carrying amount of the asset to arrive at cost of sales. What's the logic? The logic is that that portion actually is not sold by the lessor. So if it is not sold, then we do not record cost of sales for that portion. So what will be our entry? Debit finance lease receivable is still a total including the gross amount of the unguaranteed residual value. Credit sales only at the present value of the periodic payment. So in this case, it's 496,506. Credit inventories is still at the carrying amount of the inventory, 399,730, but this will not be recorded as your cost of sales because your cost of sales will be reduced by the present value of the unguaranteed residual value. Therefore, it's adjusted to 356,506. But the amount of interest that will be earned over the lease term is still 180,270 because we do not adjust our amortization table. So to record your first collection during the same date of commencement, debit cash, credit finance lease receivable, 80,000. Then at year end, amortize based on your amortization, the discount on finance lease receivable. So same computation as in our previous illustration, debit discount on finance lease receivable, credit, interest, revenue. Okay, so again, it matters in our entries for dealer's lease or manufacturer's lease that the residual value is guaranteed or unguaranteed. If the residual value is guaranteed, the present value of the guaranteed residual value will be included as part of sales. Whereas if the residual value is unguaranteed, the present value of such unguaranteed residual value will be considered as a deduction adjustment from cost of sales. However, whether the residual value is guaranteed or unguaranteed, your financial asset, finance lease receivable, will be recorded just the same, including the guaranteed or unguaranteed residual value. Okay, so you may ask, what about, ma'am, the bargain purchase option? So the bargain purchase option under finance lease or manufacturer's lease will be treated in the same manner as guaranteed residual value. So it's part of the computation of sales. So actually this is the last illustration for the lessor under finance lease. But let us summarize and compare the differences or similarities in accounting for direct finance lease and dealers or manufacturers lease. Again, at commencement, you are to record the finance lease receivable at present value of periodic payment plus one of the following if applicable. Please disregard this less than sign. It's actually comma. So any of BPO, guaranteed residual value, or GRV. So this is comma, comma. So same is true here. At commencement, record finance lease receivable at present value of periodic payment plus, if applicable, any of BPO, GRV, or URV. So here, they are similar. As far as revenue is concerned, under direct finance lease, the revenue earned is finance revenue or interest revenue, and that is spread over the lease term using the effective interest method. Whereas under dealer's lease, there are two types of revenues earned by the lessor: revenues at commencement in the form of sales with gross profit again earned during the year of commencement, and then we have the second one, same as this, finance revenue over the lease term using the effective interest method. So in our equation, under direct finance lease, the present value of the finance lease receivable will be equal to the fair value of the asset, which also equals the carrying value of the asset. Hence, there is no profit during commencement. Whereas under dealers or manufacturers lease, this is present value of FLR. So present value of finance lease receivable will equal fair value of the asset, but this fair value exceeds the carrying value of the asset. Therefore, this excess is the profit that makes it a sales transaction. Let me see whether I can edit. Let me edit just a little bit so I will be presenting correctly. We are now towards the end. So let me share again. So I am to go to slide 49. So see how long the topic list is. Okay, so again here, this is comma, and then here, present value of finance lease receivable is equal to the fair value of the asset, but that fair value, which is the selling price, exceeds the carrying value, and that excess is the profit, and that profit defines the lease as dealer's lease or manufacturer's lease. Initial direct costs adjust the interest earned over the lease term. So using the gross method, any initial direct costs is debited actually to discount on finance lease receivable and credit cash. So when we pay for initial direct costs under direct finance lease, we debit discount on finance lease receivable and credit cash. Therefore, decreasing the discount on finance lease receivable actually decreases the total of interest revenue earned over the lease term. So the initial direct costs may sometimes require adjustment of the effective interest rate. Whereas under the dealers or manufacturers lease, any initial direct costs are taken to profit or loss. They are recorded as expenses as to whether it will be added to cost of goods sold or it will be presented as a separate operating expense. It actually depends on the policy of the lessor. What is important is that initial direct costs are taken to profit or loss as expense. And the last one, there is no difference in treatment as to whether residual value is guaranteed or unguaranteed. Such residual value is included in the computation of the gross finance lease receivable and the amortized cost of the finance lease receivable. So there is no difference. So under dealers or manufacturers lease, although the present value, although both the GRV, meaning the guaranteed residual value, and the unguaranteed residual value increase the finance lease receivables because they are included here. The present value of the guaranteed residual value is actually included as part of the computation of sales, while the present value of the unguaranteed residual value is deducted from cost of goods sold. Therefore, whether the residual value is guaranteed or unguaranteed, you will be arriving at the same amount of the gross profit. Because here, the guaranteed residual value at present value increases your sales. And the higher is the sales, the higher will be your gross profit. If the residual value is unguaranteed, the present value of such unguaranteed residual value reduces your cost of goods sold. And the lower is your cost of goods sold, the higher will be the profit. Okay. Okay, so what are the disclosure requirements in the financial statements of the lessor? So for operating leases, you are to present the lease income or rent revenue, separately disclosing income relating to variable lease payments. Actually, these are contingent rents that do not depend on price index or a rate. So these are contingent rents. So for operating leases, you are to present separately the rent revenue arising from your usual lease transaction plus the rent revenue that is considered as contingent rental. For finance leases, for dealers or manufacturers lease, the selling profit will have to be disclosed. So you just present a schedule for the computation of the selling profit. And then the finance income on finance lease receivable, whether direct finance lease or dealers or manufacturers lease. Then income relating to variable lease payments, meaning contingent rentals. So contingent rentals, regardless of the method used, are to be accounted for in profit or loss during the period that it is earned. For all types of leases, the lessor will have to disclose and describe the nature of leasing transactions, the significant changes in the carrying amount of finance lease receivable, that is for finance lease only, sorry for that, maturity analysis of finance lease receivable, reconciling the gross with the net. So it is always preferable to use the gross because the gross is a required disclosure. The net is also the required disclosure. So you just deduct the balance of discount of finance lease receivable from finance lease receivable to arrive at the net. Then these amounts will have to be segregated for the next year. So the amount that will accrue for the next year, the amortized cost of that will be presented as current. So you have to present that in a matrix. Then years 2 to 5 will have to be separated, and the finance lease receivable collectible beyond year 5 will also be disclosed separately. So you have finance lease receivable that will be collected next year, finance lease receivable that will be collected year 2 up to year 5 from the balance sheet date, and then finance lease receivable that will be collected after year 5. So that's your disclosure requirements. Then for operating leases that are still held, so whose assets are still held, of course, by the lessor in its accounting records, then the disclosure requirements required by IAS 16, property, plant, and equipment, 36, impairment of assets, 38, intangible assets, if the underlying asset is one of intangible, and 40, if such is classified as investment property. Okay, so after viewing this video, You should be able to account for leases in the books of the lessor, whether the lease is an operating lease, a direct finance lease, or dealers or manufacturers lease. You should be able to present lease-related accounts in the financial statements of the lessor, and you should be able to identify and later on prepare required note disclosures relating to leases. So that actually ends part 2. So I'm stop sharing. Bye for now.